recipes for technical trading success in Cook's Kitchen.
Who's calling a top? I'm certainly not. Tops are hard to call. I'm calling a bottom, at least a short-term one. Let's go to the charts, because last week I showed you 3 key indicators that I use to signify really strong oversold momentum and getting ready to buy the correction. That was my video last week on equity risk premium and preparing to buy the correction. So let's revisit those charts. First one up, this is the S&P 1500, new highs minus new lows expressed as a percentage. I'm showing you a 5-year chart, and I've got the S&P behind it. The S&P 500 is the black line, the oscillator obviously in red. And look what we just did. In this correction, we got down to negative 15% on the new highs minus new lows percent. And we hadn't seen anything like that. You'd have to go back to early 2016 during the earnings recession to see that kind of disparity between new highs and new lows. And this is what a lot of technicians look for. They want to see, are we making hundreds more new lows in stocks every day than new highs? And if so, is that telling us that we're headed for a big correction, a crash, or even a recession? All right, another important one I showed you, percentage of stocks above their 200-day moving average on the S&P 500. I was looking for this to go below 50. It got down to 35, as you can see here, and there's actually a double bottom there. If it wasn't so zoomed out to a 5-year view, you'd see sort of a double bottom here at 34.4. But again, let's look at history. What typically happens? You're not looking for exact levels. You're looking for, extreme oversold on fear. And again, we'd have to go back to early 2016 to see anything like that. Remember, this was an earnings recession. And the other thing, whenever you look at these indicators over time, especially anything involving moving averages, in this case, we were looking at the percentage of S&P 500 stocks above the 200-day moving average. As equity prices rise, moving averages rise with them. And then when the equities fall, it's very easy to start registering, losing stocks above their 50 and 200-day. And then it takes a while to oscillate back upwards. Moving averages come down eventually, and stock prices bottom. So there's no exact science to this. You're just looking for relative strength and weakness, in a historical context. All right, what else are we going to look at? Oh, I got a great one here. This is a new one. This is, usually I don't look at the 50-day moving average for the extremes. We just looked at the percentage of S&P stocks above the 200-day. Now let's look at it above the 50-day, but go back, to the prior recession. So this actually comes from Charlie Bilello, who is a chartered market technician and the director of research for an RIA called Pension Partners. You can see his name right up here. Find him on Twitter at Charlie Bilello. So he's trying to show here, he has a note down at the bottom, extreme oversold is when you're in the bottom 3% of all values. So what he's trying to say is when you get less than 3% of S&P 500 stocks above their 50-day, it's usually a big washout level. So here we go, 2002 and late 2008, early 2009. Well, what did both of those have in common? They both had a recession in common. The next time we get that low, 2011, that was a nearly 20% correction. Not quite a bear market for the S&P 500. We saw a 19.7% correction. So I don't think that we needed to get that low. That's when I saw this yesterday. I saw this as bullish, that getting down to minus 10% or less than 10% of S&P 500 stocks above the 50-day, to me, that's as low as we need to go. All right, so that's why we started buying yesterday. All right, what else do I want to show you? I want to show you the VIX. Where have I got the VIX here? Oh, this is on my StockTwits feed. So this is a chart I published yesterday from VIXCentral.com, which shows you the VIX futures curve or the term structure. And so what's going on here is the VIX finally, couldn't get back above 25, 20, into that 27, 28 area this week. And, Amazon started to rally yesterday, and the VIX falls back, on a decent green day, decent bottoming day on Tuesday for the market. Well, so that's the VIX spot. That's the actual VIX calculation, that 23.3. Here's what the forward curve did. This actually fell several points, the front month. And this curve is in what you call backwardation, meaning the front month is priced higher. So it's indicative of fear, right? The front month futures spike up, and the curve is going like this. It's sloping down, and not the traditional contango element that you want to see during a bull market. So what I'm saying is that the curve is laying down. It's not going back to contango right away, but it's showing you a cessation of fear. Okay, where else did we see a cessation of fear? Let's see. I got to show you my Russell 2000 chart. Digging that up right now. I'll pull one up here. So we just want to see the rut. 5 years will be good. Look at that. And I got it laid over the S&P. That's fine. Well, actually, I better kick the S&P out of here. We don't need that right now. So we'll say none for a price overlay. And I actually, that's okay. Actually, I just wanted to go back to look at this breakout in the Russell. So we're going to zoom in a little bit so this is easier to see, because I just want to look at the past 2 years. And that'll show us the breakout. So define the range, 2 years. All right, now we're in business. So this is the Russell 2000 Small Cap Index. You may remember last year I called a breakout here above 1430. And once it finally got through the 1450 level, checked back here to 1450-ish. So I was looking for 1450 as some kind of support. Well, what happened, I'm going to show you the chart I showed my taser traders on, because we bought TNA. We bought the small cap 3 times leverage. Here's the chart I showed them here. This is what stands out. October 24th, Russell 2000 makes a big drop, closes on 1470. What happened the next 4 days? So Thursday, Friday, Monday, Tuesday. It would dip below there on Friday and Monday, but never close below 1470 again. What's different about that, and the reason I'm showing you that, is because the NASDAQ did make new lows as, Amazon was getting killed, Microsoft was off a little bit, Apple was trying to beat it down a little bit, Facebook obviously, even Google. So the Russell's holding up better. Of course, the Russell had a 16% correction, NASDAQ did not, but you would think that the weakest member of the indexes would still be getting hit if there were rampant fear going on, and it didn't. So I said, hey, this looks like we've got some bottoming action here. So zooming out back to the a 2-year chart, this is the support area you're looking at in the Russell, this 1450, 1470, and it got it back above 1500. Could have legs to 1650. We'll see. All right. Let's see what else I want to show you here. Okay. So I just want to make a general commentary on cycles and oscillations. Predicting a correction is hard. Nobody can time it perfectly. I was calling for a correction in August and September. One never came. We had a small short position. But what's easier is finding a tradable low, a bottom, after extreme fear, after extreme oversold conditions. I showed you how to look for extreme oversold conditions with those indicators. And you're also looking at sentiment. I mean, what's going on? Why does it appear like large fund managers are running for the exits and climbing over the top of each other? Are they afraid of recession? Are they afraid of an earnings recession, growth expectations coming down, interest rates screaming higher, whatever it is? And we talked about that last week with Mike Wilson's model. Mike Wilson, the chief strategist for Morgan Stanley. There was some paranoia going on, okay? And that's the way the JP Morgan strategist defined it, is growth managers were paranoid about the possibility of some kind of growth slowdown, and they all got caught on the wrong side. So, corrections, they're not that predictable. And, I was going to say, it's like it happens all at once, right? You want to predict it, but then all of a sudden it happens so quick. So all you can really do is be mentally prepared for it, and then, carve out some indicators and create some kind of plan so you can, wade through the flood with some discipline. All right. And the other thing is you got to have price levels too. You got to look, where do I think support is going to be? I showed you where I thought support was going to be in the Russell. I was looking at support in the S&P under 2,600. And you combine, sort of your technical levels with extreme oversold, with, high fear, but maybe fear is abating. That's what we saw on Tuesday is the VIX wasn't racing higher. The selling momentum slowed down. Buyers were coming for Amazon, and so it was sort of safe to at least let go of your shorts and put some longs back in the water. And you can't have rigid expectations about any of this. I was going to show you a book. I forgot it in my office. Benoit Mandelbrot is a name you probably don't hear very often, but he wrote a book called The Behavior of Markets, and actually in parentheses before behavior he put the misbehavior of markets. Here was a guy, I believe he was a chemist, but he started studying financial markets and saw that using standard deviation to define the risk in financial markets was completely absurd. So he coined the phrase that markets are full of wild randomness. And this is Nassim Nicholas Taleb, who wrote The Black Swan, was sort of a student of Benoit Mandelbrot's, and it inspired his work with The Black Swan, which he published before the financial crisis, and trying to describe how our standard deviation applied to markets, basic volatility, was absurd and not realistic, because anything can happen in markets. After I read Mandelbrot and Taleb, I said, when anything can happen, there is no standard for deviation. And so that's why you can't have rigid expectations about how and when a correction unfolds. There's nothing orderly about it. And how many corrections, really predict the next recession. So you just have to have a plan going into it. All right, let me just check my notes here and see if I had anything else good for you. Showed you the VIX. We looked at a bunch of charts. And we covered wild randomness. So to wrap up, having a plan once a correction does unfold is key. And, could the S&P have gone to 2,400? Yeah, we could have had one more day of panic selling, and it could have been any catalyst. But things slow down, and we've got a tradable bottom here off of S&P 2,600, and we'll see how long it lasts. Looks like the midterms aren't a factor, but any kind of November surprise about growth. We've got ISM tomorrow. If that ISM print should weaken at all, that would have repercussions, because it would be telling you that now purchasing managers are getting cautious, and whether it's tariffs or something else they see in the economy. But right now, trade off this low. All right, thanks for joining me.